Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 57 with Aaron Hunter. He is one of the only few returning guests. He's with ConocoPhillips, and we're going to dive into a lot with that. It is Wednesday, August 17th, 2022, and I know I always say this, but holy moly, there is a lot going on in the global oil market, and I'm going to get into prices and everything because they're pretty volatile and crazy, and we've had a unique sort of earnings season. But without further ado, Aaron, I'd love to welcome back to the PetroNerds podcast. Thank you so much
thanks.
for coming
Glad to be
back.
here again. Good to see you.
Yeah, good to see you too. It is August 17, 2022. We have WTI prices about $87 a barrel, which interestingly enough, the last time we had you on the podcast, that's basically where oil prices were in January. However, natural gas prices are significantly higher than they were at that time. They're more than double of that. But Brent is hanging around $92.58. We've got Henry Hub at a whopping $9.24. We're going to come back to that. I think there's some serious issues with this high of natural gas prices. I've been beating this drum in presentations, from clients to public presentations across the board, but I'm very concerned about it. And then Dutch TTF, so European natural gas prices in dollars per MMBTU, is 67.59 right now, which is just out of control. The 30-year mortgage, which is very highly correlated to the 10-year yield, if you're seeing a lot of wackiness in the market and wondering why the stock market is up when the economy is not good, that's because people trading the market want to believe that the Fed is not going to raise rates. That 10-year yield and the inverted yield curves that we're seeing suggests otherwise. So the 10-year yield is 2.906, and that is why you're seeing that is up a smidgen, and that is why you're seeing mortgage rates at 5.48%. They've moved up a little bit. So that's sort of encapsulating that. I would say the backdrop to this before we dive in, and I have, talking to someone with a public company, one, it's fantastic to have you on the podcast. Two, Aaron Hunter has actually switched roles a bit and was, when we last spoke on the podcast in episode 38, which I just re-listened to, absolutely recommend folks listening to it because it still holds up very well, and lots of great intel and information. But we talked a lot about the Midland, we talked a lot about Conoco and the market and technology. And this one now, Aaron Hunter, you're working more with the Delaware now. So we get to switch gears a little bit and talk about the Delaware, which is awesome because it's exciting and some of the best rock. I'm Midland is as well, but some of the best rock in the entire world. So really pumped to talk about that. But I would say on the backdrop, I mean, you had a very great good earnings call, fantastic stuff. And there's a lot I would say a lot has happened between when we spoke in January. There's been 3 earning calls since then. I've listened to all of them. I listened to the last one twice, actually. And I would say one of the biggest notes I picked up, obviously, is natural gas, is Conoco's push and foray, and more. You guys have always been heavily exposed to natural gas, but big stuff on LNG, stuff going on with Qatar, and the way sort of the energy transition is talked about. I think, your CEO opens up talking about with energy security more so than I think in previous calls it's mentioned, but this one's emphasized. I do think that's different from and positive in many ways, because I listened to Pioneer Natural Resources earnings call, and Scott Sheffield talked about $100 oil being the future for the next several years, and mostly talked about shareholder returns, and the business and energy security and technicals and all kinds of stuff really wasn't mentioned. And you guys had quite a bit of meat in your earnings call. So with that, I'm just I'll stop talking and let you sort of take on from there for a little bit. But I think there's a lot to dive into.
Definitely appreciate the introduction like that. It's been a crazy, 7-8 months since we last talked out in the Permian anyway. I am now over Delaware Basin. My current title is Vice President Delaware Basin. That was effective May of 2022. But I've been in Midland the past 17, 18 years. So I kind of knew of the Delaware anyway. I've worked Southern Delaware in the past, the Texas Delaware in the past. This is New Mexico Delaware is new to me, but I'm learning, picking it up quick. But yeah, to your point, there's just an amazing amount of resource out here in the basin between the Midland and Delaware. One fun fact: of course, this is titled PetroNerds, and you're probably more nerdy than me, but I'm almost equally nerdy. One stat I just fell across yesterday is from 2010. This is only Delaware Basin, 2010 through roughly mid 2022. If you look at horizontal footage drilled to date, it's about the same amount as the circumference of the Earth. So quite a bit of horizontal drilling in the past 12 years in Delaware to drill 24,000 miles around the world. So
that's everyone.
That's all operators. Yeah, that's all operators from the public data. That comes up to about 25,000 miles of lateral. So yeah, and of course, all kinds of
Nice.
resource that comes with that. Just tons and tons of resource, oil and gas, and tons of NGLs. All the WTI and WTL mixes in there as well. Just a phenomenal resource. Part of the reason I was looking at this stat anyway was just to figure out how much drilling is left in the Delaware, and it's obviously a ton of activity to do out here.
Yeah, so I mean, I think we can start there. I mean, I want to talk about the Delaware and the differences sort of with the Midland, and I really do want to talk about sort of in the previous podcast we talked about spacing and the shift between a bit of up spacing. The Midland is different in the Delaware in a lot of respects because it is a little bit shallower, a little bit more well known. We don't have I mean, the Delaware is deep. It's overpressured. It's hot. It's thermally mature. You have a lot of gas. You have a lot of gas drive. You have multiple stacked pay zones. You still have multiple. You have many of those things in the Midland, not quite so much. And Midland's very well known. And I think part of why you had a lot of companies, ones that were willing to take the risk. We saw companies early on take bigger risks in the Delaware with bigger returns, and you saw some monster oil wells. But you also had a lot of gas. And before in the beginning, sort of the Permian, I mean, gas was a problem when you didn't have the takeaway capacity. And I would argue we're probably nearing, I'd love to talk about a little bit of gas stuff, especially in the takeaway capacity. Something that's talked about a bit in several of your earnings calls, at least mentioned a little bit, is, watching and being cognizant of takeaway capacity. Conoco felt pretty comfortable that they have it. But I think as everybody's geared with natural gas prices that high, people are not afraid to produce natural gas anymore. And so as long as you have the takeaway capacity, you're going to be producing it. And if folks are concentrated or focused on the Delaware, and that's where the majority, I mean, you have rigs in Midland, but that's where the majority of your rigs are, is that there's great things about it, but there's also a lot of gas. So I'd love to talk a little bit just of the sort of stacked pay, the thermal maturity, you're getting this nice gas drive. And I want to get into some, we can talk about spacing and everything, but love to just talk about, I mean, I think the last time we talked on the phone, I mean, I would say a year ago we weren't seeing it, but now there's probably a little actually okay. People are not necessarily directly targeting, hey, I'm going just after the gas, but they're definitely okay with going for gas drive, especially if the price is
definitely.
Right.
I would say there's been a steering away of more of the traditional, I guess, upper zones where you got a little more dead oil, more water, towards the deeper zones. Obviously, Wolfcamp A is still a big resource out here, but there's deeper zones than that. Wolfcamp B, Wolfcamp C, they bring a ton more gas with them. It's initial rates of 1,000 to 1,200 oil, but 8 to 10 million a day of gas out of a 2 to 3 mile lateral. You can knock those out pretty quick as well, relatively quickly. Obviously, being Wolfcamp C or deeper than that, even it's going to increase cost. It's harder to drill, much harder to frac, which slow things down. In the deeper zones, you're dealing with like a 0.95 psi per foot gradient, just pressure gradient. So very, very undersaturated, but also very volatile oil. So you bring these things on, and in the reservoir, it's liquid, but as it comes up, it evolves to just a high BTU gas, and it's pretty prolific wells right now. We're looking at on that state line area, kind of the western area as well. Us and other partners we're working with are just there is a trend towards this. Of course, like you touched on, between Henry Hub or international gas, it is especially when you're trying to get it on water for LNG. It's just phenomenal economics right now on the gas out here.
And I mean, partly that's because you are very close to market. So this is a bit different than if you're sitting in the DJ, you're sitting in the Bakken, and you're trying to get that gas to market. So you guys are close. Obviously, if you're in the Permian or in the Eagle Ford, which you guys are in both, you guys have exposure. You guys have exposure to the Gulf, and it's easier as long as you have the infrastructure to get it out. But that is impacting, and we'll circle back certainly on natural gas and LNG and the global space and many of the themes that were mentioned in the earnings call. But just from the I guess the focusing on natural gas from the drilling perspective and where the bit's going and what you're producing in the Delaware, is that's not foregoing any oil production, correct? I mean, you're also gas drive is a big component of this oil, so maybe it might be a little lighter and more volatile and technically more condensate. I'm guessing some of this is a higher API gravity, but with prices where they're at, that's all. NGLs are favorable. Even condensate's probably. I mean. When you're north of $80 a barrel, I mean, all this stuff is getting pretty good prices, and you're close to market. So I imagine that's good. But the technical piece of are you drilling in different formations, and are you mowing it down, or are you sort of being able to target different formations and come back to the other zones? And I know that's a lot there, but
a good point.
Sort of take what you want.
Yeah, so I would say, nobody is foregoing oil over gas. If anything, they're just shifting to gassier zones. Still a ton of us, whether it's a gas well with associated oil or vice versa, we're definitely still targeting the oily rich zones, just going for more gas rich, higher GOR basically. And to your last point there, that has been an interesting shift between Midland and Delaware. Is I think for the again, Midland's very complex, but it's also pretty homogeneous east to west, north to south within the fairway. For Midland, you see a lot more, a lot bigger projects, a lot bigger commitments of drilling down two sections at a time. For Delaware, again, this is across industry and just kind of looking at the average of who's doing what. There is a lot more in 3 and 4 well projects, just because again, cycle time and cost and commitment. There's a lot more. I guess the average is drifted towards a lower well per pad, well per project development scheme over in the Delaware. Some people like to target the Second Bone Spring, Avalon for the kind of cheap, quick hit. On their bigger companies like to go for the deeper, get the deeper stuff first, and then work their way up the hole. But there is probably a definite shift over here between project size.
And does that, so, I mean, having a slightly smaller project size, I mean, and do you think that's a long-term positive? I mean, that this really is, it's sort of, you can take it a little slower because you're going deeper and then you can shift over into more zones. It's not necessarily where you're foregoing folks are not foregoing zones. I can't imagine that, we talked in the previous podcast about a little bit of upspacing and things like that, but I can't imagine, and part of that was, the bolt-ons and longer laterals, but I can't imagine this is folks really wanting to forego actual wells in the ground. I mean, this has got to be a much more thought out process of, we're hitting this zone and we know we can come back to this zone at a later point, and we know it's going to be economic.
I think given the depth and the overall breadth of the stack in the Delaware, there is more zonal isolation between things, whether it's between Wolfcamp and Second Bone or whichever zone. There's a little more carbonate maybe as well. So I think most companies feel like there is more isolation between zones as far as parent-child stuff or interaction north and south on that. I will say though, there's other companies out here that are they're still proposing 60 well projects across multiple benches and multiple sections. So there is definitely big projects in the Delaware. I think just the amount of smaller operators out here that maybe can't afford or don't have the acreage to do the big projects. That's why the average would shift towards a little bit lesser project density. And I would also say to your earlier comment.
Right. And I would say that. Go ahead.
I was going to say on your earlier comment around spacing, I think for the most part, again, in broad averages, I think we're included in that average. Spacing kind of has normalized as far as the, I would call it lateral spacing, east-west. Now, people are still tacking on zones above or below on their zones, but in each particular zone, all the learnings the industry did, ourselves included, back with Concho, but all the tight projects we all did, I think, and then you see those kind of upspace a little bit with oil price, and then now maybe trending down slightly as we optimize and tune things. But I would say for the most part, again, it's going to change where you are in the basin, but when you're in certain fairways, I would say that the spacing is getting pretty narrow on a lateral sense.
Okay, no, that's a great point, and we'll come back to lateral length and stuff as well. But so overall, I mean, you've got Conoco has 14 rigs. Most of these are in the Permian Basin. Most of these are in the Delaware. That is an uptick from over the course of the past 2 years. You've sort of upticked and increased activity. I do think it's important to point out that if you're following the last 3 earnings calls, I think that there was a trend and theme of the increase in capex, right? That was noted of saying, one, partly because of inflation and not crazy inflation, that you guys are obviously trying to control that, but we do have inflation, and we'll come back and talk to that. But that there was an increased capex because you're wanting to add more wells, and I think it was clarified that sort of 90 wells were turned online, if I have this correct, in the first quarter. 500 wells were planned for completion for the year, and that would sort of be back heavy. And I may have that wrong for just the Permian, but that was a couple quarters ago that was slated as it would be a little bit back, heavy on the back end because 90 was the first quarter. But the point was that there was a lot of wells being added. And I would just like to get your thoughts sort of and feedback on that, on the Permian specifically.
Yeah, so I think I heard that comment in the earnings call as well, and I think that was from Jack. I think that was from more of a lower 48 number as far as the 500. But lower 48 in general and Permian, we are back weighted to the back half. Just obviously when you're picking up activity in rigs and doing bigger projects, just project cycle time is going to kick them to the back half of the year anyway. But yeah, looking at the Delaware, from my side, we've got multiple big projects coming online in the next quarter. I'm sure it's all public. You can look at it in the New Mexico websites, but we are definitely back weighted, even in Delaware, back weighted to projects popping soon, probably third quarter and fourth quarter. both elevated, but they're part of this
Right.
larger projects as well.
Right. And I think, I know that in you guys also talking your earnings call, there was a question to reiteration. I think a few quarters ago asking about what's the production guidance and outlook for the year. And I think something around 800 to 900,000 barrels a day, entry to exit for 2022. I think there was a comment that it was this, looking at overall US, that this would maybe be a little lower in 2023 given inflation. I think 800 to 900,000 barrels a day is a pretty healthy number. I'm in line with that. That will be well north of, I think we'll be well north of 12 million barrels a day by the end of the year. And I think that that incremental add is certainly important to be thinking in the context of, where's the global oil macro, not just supply, but demand in the global economy. It's really important. And I do think that as production lags, and we see that a lot, if you're trying to look at data from Invarious through Prism or whatever, and other data that yes, EIA is showing bullish numbers. We talked
Right.
about in the last podcast of probably Permian around 4.5-5 million barrels a day. And I re-pulled up the numbers and was looking at your guys's, and I believe so. Conoco is about, I'm guessing you're about 375,000 barrels per day, and I'm not saying BOE per day. And I know that's really relevant now because that's how you guys say it, and obviously the gas has a lot to do with that. But I'm guessing about 375,000 barrels of oil per day in the Permian, Midland being about 125,000 barrels a day, and Delaware being about 200,000 barrels a day.
That's pretty close. Yeah, I think from the call, Permian did 634,000 BOEs from the lower 48, and about half of that is from Delaware, or from Permian. Yeah.
Right. Okay. So that makes sense. And I think, and obviously that the data is lagging a little bit. I was looking at Midland. You guys are showing roughly 14,000 foot laterals, 11,000 feet over the last 2 years. And we talked extensively in the last podcast about, those longer laterals in the Midland. I think the 14,000 foot laterals is pretty significant. I mean, that's showing on average, you're punching, 2.5 miles. And obviously folks are talking about 3 miles. And I would like to get into that. But I think it's and we're seeing a Delaware, not Conoco, but the entire Delaware on average being 9,500 feet. That's a significant trend upward, but we're still not at the sort of, the length we are in Midland. And Midland is about 12,000 feet on average. And I think that's really, really meaningful. But can you, for listeners, sort of backtrack that and think about the Delaware, we have shorter laterals. And part of that is because I think, companies like EOG are vocal and that they don't necessarily go after the longer, just they're doing it longer just because some of their laterals actually look shorter. There's a number of different reasons for that, but I would love to know, what are your thoughts on shorter laterals in the Delaware
I
overall?
think starting from a technical foundation, there's nothing that would give me concern with long laterals between Midland and Delaware, whether it's 2 miles, 2.5 miles, 3 miles. Even we did the 3.6 mile lateral in Midland Basin, but that was more of a leasing structure and how the acreage is mapped out. It wasn't necessarily because we wanted to do it that way. But I guess economics on that was better than splitting it into two 1.8 mile laterals, if that makes sense. So I would think Delaware, again, each operator is going to have their own specific choices and what they're going to do. But I think that if for Delaware being shorter, my assumption would be that's just what the leasehold would demand, or that's the most you can pull in, or kind of do the daily knife fighting of trading in and out of acreage. I think the limiter there would be this more acreage position bounded rather than technical bounded. It's certainly that's how it is for us.
Right.
Every day, and you heard on the call as well. Since the Concho acquisition, we've done 25 trades to bolt stuff together and try to trade up and either trade up in certain areas to get a longer lateral length, or trade out of other areas where we can't drill, where we don't want to drill 1 mile laterals, frankly. So I think that's been a key piece for us out here, is just the trades going back and forth.
And we had talked about it before about the role of privates, right? I mean, private operators are extremely significant overall in the U.S. I was re-listening to our podcast, and I love we have a big conversation on ducks, and I think it's actually really relevant in terms of these private companies, because if you just pull up ducks and you look at where these private companies are at, there's so many holes being poked in the ground, and a lot of these privates, and if you just look at the map of the privates and the publics, forget about what a duck is or isn't. It's a hole poked in the ground that's going to be brought onto production at some point. And so I think sometimes we focus in on those production numbers a little bit too much, and don't realize that production's coming online, even with stickiness and inflation and having a hard time getting truck drivers and lag times there. Like, the production will eventually come online. But in the Delaware, when we talked about before, we were talking about the role of the private operators and lots, obviously, on the Midland side. But you're alluding to, we do have a lot of private operators also on the Delaware side. And those private operators are sort of intermingled. And that means that, so if you're part of the reason you don't have excessively long laterals is because that acreage is not perfectly blocked up to drill a 3-mile long lateral. And I had somebody on the podcast with the Troy Ruths, with the CEO with Petro AI, and we were talking about these privates, how complex that is, because they're sort of, if you're nestled in between other operators, you have to deal with that from a spacing and completion perspective in terms of how to maximize those well results. And I would just, would love to get your sort of feedback on the role of privates sort of being nestled in the Delaware, and how that's sort of, how that's working out in the Delaware with publics and privates, what sort of the trends you're seeing. Any color and information you can give on that would be great.
It's good to think about. The way I think about it is, so there's roughly 300 rigs in the Delaware, in the Permian right now, probably 60% weighted to Delaware, 40% to Midland. But let's just call it 300 rigs in the Permian right now. I think it's anywhere from 50 to 60%, more than half, but somewhere between 50 and 60% of those are with privates. And then, 40 to 50%, call it 55, 45. The other, the 45% would be with publics. But the flip side of that is, I think probably 80% of your, maybe 75% of your base production coming out of the basin is owned and controlled by publics. So the way I kind of think about it is, you've got 45% of the rigs that are supporting and maintaining the flat base. Then the other 55% of the rigs that the privates have, they're the ones, they are that growth wedge. They're the growth wedge on that, call it 25% wedge, though. Does that make sense?
Right. Yes. Yeah, absolutely. And I think that's something, we sometimes focus a little bit on the, the rig so much in the public and private split, which I like to show a lot from an activity perspective. But yes, the vast majority of production, which you guys control, one of the biggest, you have a massive amount of production in the basin. The vast majority of production is controlled by and swung by the public. So no, that makes great sense. So let's switch gears a little bit into like, obviously we're talking about levels of activity. I would say on the technology side, and sort of we touched a little bit in last time about wet sand and what's going on there. And I think that is a little different in the Delaware than it is in the Midland. So I'd love to talk about, we talked about frac efficiency, simul-fracs, wet sand. I think the weight of inflation, and you don't hear this as much in public earnings calls. It's definitely talked about, but certainly in the investment community, when folks ask me, I get a ton of questions. The feedback I get when I talk to private companies is inflation is a really, really big deal. And, the ability to get workers into the field, the ability, just getting pipe, just getting, tubulars, casing, you name it, just getting it, is difficult when they're trying to actually plan their operations and get all their ducks in a row, no pun intended. It's actually really important. And so when a truck driver quits and then you can't get that sand on location that day, this is something frequent that you hear about a lot. So I'd like to touch base on that a little bit in terms of, we can talk Delaware specific or all of Permian, but you guys obviously talk about inflation, and in previous calls you've mentioned sort of some of those factors, OCTG, sticky factors, labor, etc. But what's, that also bleeds into sort of frac and efficiency and simul-fracs. And I know that's something that's big that we talked about before of, where's the growth and trajectory of that going, and the efficiency on the frac side. And those efficiencies seem to, they really matter when you have all the stickiness elsewhere and you're trying to manage that, and you're trying to sort of offset not just the cost, but the time, and make sure that you can keep operations flowing. And obviously you have massive operations. So would love to get your thoughts and perspective and feedback on that to the extent that you're comfortable.
Absolutely. So, you heard it on our call as well. And even Ryan said it, Bill talked about it. Inflation across the industry, whether it's Permian, whether it's Midland, Delaware, whether it's global, inflation's real. I think Bill talked about the 9% inflation on our call. That, of course, there's probably some global blending there, maybe slightly higher than that. I've also read it might be slightly higher than that in the Permian. I've also read a couple on their Permian only public releases, and I think we're all in line seeing similar inflation in the area. But that's just cost inflation. The hard part, which you've already touched on, is just I kind of think about it like, whatever, driving a race car, whatever. When you're going too fast, when the wheels start to wobble, when things get a little shaky. I think for the kind of the support structure in the Delaware or in the Permian in general, things are getting a little shaky just from waiting on pipe being delivered, recent issues with cement getting delivered. And of course, the cement's there. It's just getting it from point A to point B on time. A ton of logistics. I recently drove down to Alpine for a music festival, probably, I don't know, 3 or 4 weeks ago, and then driving back up from Alpine through Pecos and then on I-20 back to Midland. It's just it's a rodeo out there, of course, just every day what people are dealing with. So as things break down, as you're dealing with, maintaining equipment point forward, I would say the wheels are wobbling in the industry right now of just trying to be able to keep up with pace. Obviously, from sand to pipe to cement to replacement parts to anything, you got to get it from point A to point B and load it on trucks and get it there. And there's a ton of activity going on out here.
And is that, I would, I mean, there's a lot to sort of talk about and unpack just in that. And I'd very much agree that's, I think everybody's sort of feeling that and seeing it. How much of that, in terms of 2014, and obviously the Permian Basin was not where it's at now. You actually didn't hit an inflection point of vertical versus horizontal rigs until sort of into 2014 in the Permian. But in the Bakken, we certainly felt like that in the Bakken. If you were drilling and producing in the Bakken, 2014 was Bananaville, and everybody was going crazy and spending money, and you had to spend extra just to get it done. Is it like that? Or, I mean, I feel like it's different in a way that yes, the activity's ramped up, but it's also not being able to get things. Yeah. And, you could pay enough to get a person on site. So I'd just like to, what are your reflections on that and how different it is?
Yeah. So it's definitely, I can definitely speak to that. It's activity's up, but it's I guess a force multiplier would be the right word between activity up and efficiency up. We did a similar to what Chevron announced in their public stuff a couple weeks ago. We did something similar internally. If you look about 2017 to 2018, where we were, just as far as think about a metric as far as production added per year per rig line, and call that kind of your index point of 1.0. Fast forward to 2022 with longer laterals, upspacing, bigger fracs, drilling faster, moving faster, simul-frac, put all those kind of multipliers on top of there. We're getting anywhere from 2 to 3 times oil per rig line per year out of the basin than in 4 or 5 years ago. And that's we as an industry, of course. Conoco's right in the average on that. We've been tracking a bunch of data around this. But when you think about just, for a rig operating in an area and a core operating in an area, you're getting anywhere from 2 to 3 times more productivity from where we were 4 or 5 years ago. That's what's causing the kind of the infrastructure wobbly. What I call the wobble on the infrastructure is we're not just you can't just look at rigs anymore. It's everything that comes with it as far as efficiency gains.
And from that, I mean, let's talk about the frac side and the simul-fracs. And I know the same thing for rigs. You can't just look at the, here's the frac fleets, and that data is pretty limited access. Everybody, that's all restricted now, and everybody wants you to pay for it. So I can't actually tell you how many, because I don't have access to it, that how many frac fleets are running exactly right now in the Permian Basin. But that, I wouldn't say that's irrelevant. It absolutely matters. But the ability to sort of add frac fleets, and I know Liberty Energy and several, folks are adding frac fleets back, right? They're reactivating fracs because the demand is there and folks need them and they're reactivating. But we had talked about simul-fracs before and the efficiencies there. And I'd love to get your thoughts on, from where we were in January to now. Are we progressing on that simul-frac operation? Not just simul-fracs, but I guess, dual doing stuff simultaneously, having efficiencies, or is some of this hitting the breaking point? I mean, sort of we're simul-fracs right now. We're sort of the frac side right now. And we can touch base, but, feed into that a little bit and talk about, the different tiers on frac fleets and nat gas, because I do think that's important on gas pricing. So
you bet.
Have at it.
We are, at least for Conoco Permian, me personally, I'm a big fan of simul-frac. The hard part there is you definitely need a 4 to 6 well pad. So you can't do a 2 well pad, can't do a 3 well pad. You might be able to do a 5 well pad technically, but they really want 4 to 6 well pads to do simul-frac just because of the way it's structured. So you got to convince the number one, that takes a big commitment. If you're not big enough of a company to do a 4 well pad, that limits some people out of not being able to do it. But then there's the other piece is, you basically have one big frac crew on location that's pumping twice as much water per day. So if you don't have the infrastructure to get yourself that water, if you don't have the sand commitments to get you that much sand per day, then there's really no use in doing simul-frac. But we've seen went from anywhere from, this is Midland Basin. We do have a couple cores, or from time to time a simul-frac core in Delaware, but for Midland, we were doing anywhere from 8 to 9 stages a day on a zipper core, up to 16, 17, 18 stages a day on simul-frac. So it is a nearly doubling of efficiency. Maybe not efficiency, but pump time going downhole. We're definitely big fans of it out here. We can talk about tier 2, tier 3 as well, where we're trying to adopt that as much as we can. But I think there is future growth towards more simul-frac out here. It's just a much more efficient use of equipment as well. I would say there's probably again, I'm not a technical frac guy. There's probably a little bit of synergy there on the all the horsepower pumping down 2 wells at once, maybe a little less maintenance rather than 2 cores. But yeah, we're big fans of simul-frac personally and in the basin.
And on the so in this progression that we've seen, on the frac side, in terms of at least the desire, I would say sometimes we talk about demand, but maybe desire for, the electric frac fleets, which we hear from operators, and you guys obviously you were the first company to do your net zero push, which we definitely need to touch on that triple mandate and energy security a little bit. But that's piece of it, right? Is a lot of companies, public and independents, and the majors, all pushing for electric frac fleets to help on their CO2 and their emissions footprint. And then we talk about different, basically it's the fuel that you're using, right? Of how are you drilling with? Is it diesel? Sorry, on the frac side, or is it natural gas? And I do think there's a bit of a problem now if we've got $9 natural gas. So I'd love to just get your perspective on the fuel, the electric frac fleets, the fuel we're using, the efficiency of the frac side, and sort of the cost there, and how diesel and nat gas, and how you guys are, maybe not how you were thinking about it, or how Conoco's thinking about it, however you want to cover that.
I love talking about this, of course, from our last podcast. I'm more of an energy guy than an oil and gas guy, but you touched on e-frac, and there's also the e-rig we're going running down the road of, just again as an industry. Just for some numbers though, if you're talking purely e-rig or e-frac, a drilling rig, if you want to plug it into the grid, it's going to pull about 3 to 4 megawatts off of the grid. That's not a problem for the grid to supply. A frac core, though, frac cores, if you're a regular core, it's about 30,000 horsepower. If you're a simul-frac core, it's about 50,000 horsepower. And if you convert that to megawatts, it's about 20 to 30 megawatts that you need to put onto the grid. So I don't know if our grid, again, collectively out here in the Permian, I don't know if our grid is quite ready for full e-frac out here. As much as we would support it. So there's a little nuance when you say e-frac. There's actually, what they do is they set a natural gas driven turbine on location to generate these 20 megawatts. And then again, we're all for that as well, because then you're nearly 100% off diesel and you're running on pure gas. But back to your point on gas prices right now, if we can get to the point where we can use field gas rather than trucking out LNG or CNG, if we can use field gas, there is still a pretty good savings on burning field gas in the turbine to power the frac fleet, relative to, again, because yes, gas price is definitely up, but so is diesel. So it's still an economic trade-off in the positive way to run the tier 4 dual fuel, or to do this gas e-frac as well.
Right, and I think that's why, folks probably, I guess, the appreciation for being very nimble in the field. These sort of microgrid solutions, and building able, especially as e-frac gets built, the microgrid solutions that, sometimes we have to actually pull ourselves away from it just being a pure environmental or ESG thing, and really more about what is the most efficient and cost effective, and, flexibility for the industry to progress at different commodity prices. And I'm guessing there's times, obviously, as you alluded to or pointed out, that field gas makes total sense, might not, especially if we can't take this away. And, 18, 19 BCF a day of associated gas and dry gas production, or gas production in the Permian, it's a huge amount of production. We are producing gross withdrawals in the U.S. around 120 BCF a day, billion cubic feet per day of natural gas. We have a lot of this stuff. And so in the Permian, as we were talking about before about gas and gas prices, we're obviously, you're not producing, most targeting, you have the capturing, but I have a feeling, and I know we have lots of natural gas, pipeline projects coming online, and there's a planning for this. But sometimes you can have dislocations, whether it's a month or 2 months or 3 months or 6 months, where things are a little bit tight. And that's probably when, obviously, there's a huge ability and need and incentive to use field gas that could really be helpful and flexible in those times.
Agreed. So certainly for anywhere we can in the Permian, but if we have the field network to use field gas, then that's the number one way for us to save money and win on any kind of e-frac or even tier 4 frac solution. Again, I'm not 100% tied to the frac side of things, but I think I'm thinking like far west, Eddy County or North Lee County, where you're kind of isolated on a small lease. I think when you start doing that, there's probably not much of a savings between the diesel and the hauling compressed natural gas that far. It's still the right thing to do economically to do gas rather than diesel, but your margins probably shrink down on the savings there.
Yeah, and I mean that's the point of, so if you're looking at 924 natural gas and 87 WTI, and obviously diesel prices are really high, but if the refinery side, which I've talked a lot about on previous podcasts and presentations, I mean, our refinery side is a bit out of whack, obviously, because we've had 1 million barrels a day lost refining
Right.
capacity in the U.S. and total a few million barrels a day lost refining capacity. So we're still out of whack. You can go to the gas station, you can see gas prices have come down, diesel prices not quite so much. So we're a bit out of whack there. But as those come down, if you're let's just say we're at $80 WTI and diesel prices come down, think the economics on if you're at $9 nat gas, things are going to flip. And that's what we're obviously seeing in Europe right now, with when you have $67 and $68 an MCF, and your dollars per megawatt hour, I believe it's the equivalent of it's $400. It's basically the equivalent right now per megawatt hour of $400 a barrel of oil. So the reason why you're seeing so much gas to oil switching, which is again the fact that we're $87
Right.
WTI and we're seeing massive gas, additional gas to oil switching on the electric side
Right.
globally, means that there's stuff going on the demand side. But it's something that I know it's not the same as talking about the Permian, but it is kind of the same. I mean, you're seeing folks in Germany and all over the world switch from a power sector from gas to diesel, because the diesel is actually significantly cheaper, just because those prices are so out of whack. And I think that 924 nat gas in the U.S. is really, really concerning, because it is, it's obviously impacting electricity prices. It's impacting people's ability to heat and fuel homes. But it's pretty unsustainable when you look at, when we were at these prices last time, it definitely led into a recession. There was housing and a gazillion other factors, but it's really huge. And I think for the industry, I imagine it's definitely it has to be a forefront of, hey, these prices are great, but we're getting a little, especially when we're seeing a little bit of softening in demand. We're seeing WTI in the 80s and we're seeing nat gas prices go up. That's got to be something, that oil companies are thinking about, saying, okay, we got to navigate this. And that means that we're seeing softer demand for oil, but high nat gas prices. And that's going to be complex.
It's completely agree. It's amazing what it kind of still all boils down to economics, doesn't it?
It absolutely does. And it's tricky, and you just have to, walk through it, closely navigate it and figure it out. I'm not saying that this stuff isn't economic. So we can put a pause in it there. I think this goes into, in your earnings call, I think you open up and it talks about, you talk about, your executives talk about the macro and energy security. And this has been something that's been emphasized in previous calls. In our actually previous podcast, it was done in January, and we were talking about Russia and Ukraine. And before the invasion ever happened, the buildup of troops and what was going on that side, and that nat gas prices were around, they were around $4. Actually, they were $4.67 at the time on January 28th, 2022. And so obviously we're seeing double of that. But this energy security point, and I think this is something that Conoco's really leaned into, as other companies as well, is that one, integration on the LNG side, but it's sort of with your triple mandate, which is, your ability to sort of meet the energy, transition demand. And I think actually I thought long and hard about this, because I know I've criticized it before, but the way this is being conveyed now, you have a lot of flexibility, because there's an emphasis now on how long nat gas and oil are going to be there. The net zero, which I do disagree with, but you have that. And then the third thing is the competitive returns, which I agree with that. But this sort of, the first piece of the meeting the demand, I mean, in this last earnings call, the natural gas is so emphasized because of your agreement with Qatar and ramping that up. A lot of talk about supply chains and the integration of LNG and sort of the, what it's going to look like in the future, and the fact that you produce so much natural gas, you can get it to market. And so obviously investing in LNG and exports is significant, but that it's still going to take time, right? That is not a switch that's going to turn on tomorrow. You guys are obviously being able to market your gas, and if you're able to market your gas and export it now, you're capturing those prices of LNG. But obviously in the future, even if gas prices are a fraction of what they are now abroad, that's still vastly more than we're getting, and you'll probably get in the future. So it's something to think about. And that really plays into sort of, I think that, as was mentioned, is in the earnings call is Ukraine, how oil companies are thinking about natural gas now, oil companies are actually thinking about the energy transition, and natural gas as a transition fuel. Now, personally, I would explain it and express it a little differently. I think companies were a little bit late to the party in terms of saying that the world needs energy, and recognize that. Although I still really respect that that's how the call was opened up with, and that energy security is really important, and that we need to be producing energy. And I think Chris Wright, and I've mentioned this a ton, but he actually spoke directly in the Liberty call, saying that if we in this industry aren't able to talk about what we do, and that we have to be producing more oil, no one's going to do it for us. And I really was extremely disappointed in some other earnings calls where, folks are talking about Colorado and the ESG, and they're linking, the permits in Colorado and ESG. And, energy security is not one of the biggest things being talked about. And that's extremely serious, because we are the company, you guys are the companies that are producing the oil and gas that people need. And so at the very least, you need to like what you do, and be behind what you do. And I think that's just extremely important, and it's critical because, and be investing in it, as opposed to, being talking more about the renewables, which can work, but just not in this environment. And I don't even know if they can work, honestly, in the future, but it's just really critical. So I know I've thrown a lot at you, but I think that natural gas piece, the energy transition, and how you guys talk about it, and how you guys are, investing in it. And I know it's not directly related to the Delaware, but I mean, it is. So to the extent that you want to, jump in on that, I'd love to hear your thoughts.
Yeah, definitely. So I definitely, coming over from Concho to Conoco, and the triple mandate was kind of new to me. But the more I see it, the more I read about it, the more I hear Ryan and other ELT members talk about it. I do stand behind all three legs of it, including the net zero ambition. I stand behind all three legs of the mandate. The first one, like you said, mentions to me, meet the transition demand. When we transition, how we transition, what we transition to, I don't know, but you've seen the same EIA reports that others have seen. Is, when you look at whether it's domestic, whether it's global, whether it's oil, whether it's gas, whether it's coal, there's no energy source in the next 50 years that's declining. Oil is either flat to up, natural gas is definitely up, solar green is up. Everything's either flat to up on energy. So we're here to meet that demand. Definitely, energy security is a key part of that. Whether it's, again, domestic and energy or international, we definitely. I also read Chris Wright's the company, their statement. Was it make human lives better? I can't remember the exact term of it, but I read that, and I think very great piece of work by them. But we are here just to fuel and fund energy to the world. It's part of what we're doing. It's part of what the Sempra thing that we did as well, is to more access to international and LNG markets to help broaden the scope of natural gas. So definitely agree with the meat transition demand side of things. And obviously, we're a publicly held company, so we have to, and we need to believe in need to deliver competitive returns on and of capital. You saw the earnings report as well, increasing the buybacks, increasing the variable return of capital. And again, the Sempra and the Shell deal, both of those are going to be fantastic investments. So we are returning on and of capital. The net zero ambition, obviously, we can debate that. There's all kinds of churn in the market about that, but that's a company directive we've decided to take on, and we're going to meet it. Of course, we've got lots of time to do it. It's a 2050 ambition, and we're working internally on how we're going to get there. And I mean, obviously, it's kind of like everything else. The top 80% is going to be very, very doable. The top 20% we'll figure it out as we go down the road. So I definitely stand behind all three sides of it. But to your comment earlier on
Awesome. Well, I know.
Sorry, to your comment earlier on U.S. energy security, I did a little research over the weekend. It's fascinating to me that the Permian combined with Midland makes about 18 BCF a day of a 91 BCF market. Mm-hmm. So was that 20% of the Permian? 20% of the U.S. natural gas energy comes from
absolutely
10,000 square miles out here relative to the rest of the size of the U.S. Pretty important to what we're doing out here. And then within that, Conoco, I think this was on the earnings call last week. Conoco markets and moves about 8 to 10 BCF a day. So we manage and move about 10% of the U.S. gas as well. So we definitely believe in energy and energy security.
Well, no, and I think that's fantastic. I appreciate the explanation, and I don't mind. Obviously, I love a guest who interrupt, and I don't mind getting pushback or disagreement. So, and I really appreciate the explanation. So, I think that's fantastic, and I love that you clarified how much, because I think the earnings call said something 7 to 8 BCF a day. Obviously being an integrated market. Really good point on the Permian that you just mentioned of that 20. It's 18, 19 BCF a day of the market. I mean, also it makes me think of if you're just looking at New Mexico, and I tell people this, but New Mexico alone is producing 1.5 million barrels per day. So that's Lee and Eddy counties. That's 2 counties. That's a little sliver of producing 1.5 million barrels a day. That is incredible. So that is more than small OPEC countries. It's a massive amount. It's some of the best rock in the entire world. I mean, obviously, I love all of the Permian Basin, but it's a gift that's going to keep on giving. There's a lot of rock there. I'm not concerned from a technological perspective that we can pull more out of this and put more wells. I mean, that doesn't even include, future, EOR and enhanced oil recovery and refracking, et cetera. But I just think it's extremely important because that's why I'm a little bit more cautious on investor pandering in terms of the net zero stuff. And it's because that when we start linking, it's been done in Colorado where the ESG stuff is linked to permitting, and talk about it permitting, and no, we're getting permitting and now we're doing our ESG stuff, and it's like, well, you have to be very, very careful on that road you trend down, because obviously I think that the bill, the Inflation Reduction Act, which is also called now the Climate Change Bill, and who only knows what they want to call it tomorrow, but that was signed into law yesterday. And I believe in your earnings call, it was actually mentioned that, hey, there's not a lot of clarity on a number of these things. There's some great things from carbon sequestration credits, but actually there's supposed to be another tack-on bill to clarify a bunch of the energy stuff. And it gets confusing and gets complex. I mean, obviously Joe Manchin went for it because he wanted a pipeline built. The likelihood of that getting built, I think, is maybe a little bit low, if not incredibly low. But the point is that you can't have the net zero stuff actually came, I'd say not necessarily net zero. Paris Climate Accords are sort of what started, here's where we need to be at 2050. And that's where the International Energy Agency tacked onto that with their net zero 2050 report. And that net zero 2050 report says you should not be investing at all in oil and gas. And so, I think it was something easy for industry to sort of grab onto and say, this is our plan, this is what we're doing. And that's what, investors seem okay with that. I think it's also at the time where oil prices are high, right? So oil prices are high. This is something that can be invested in. It's tangible. It's something the market can be told, and a lot of companies tagged onto this. But I think in terms of and what you guys have been very good about and talking about now, and especially in the last 3 quarters, I think is emphasizing is that we're willing to actually grow production. I mean, not crazy. You're not saying, hey, we're going to add several hundred billion, we're doing this, but you're saying, no, we're going to grow production. I think few companies have said we're increasing our CapEx and we need to grow production, and we're talking about energy security. And that's I think a difference. And I think that's meaningful, and that more companies, and you guys have sort of, explained that and expressed that. And I think that's what's important is that, industry leaders, you're putting a drill bit into the ground, and you're producing a commodity, and you're producing something that folks need. It's really important. That's how you're actually making money as well. So yes, shareholder returns are important. People, delivering strong returns and being an investable company. But I think as time progresses and the world has changed a lot, and you pointed out that look at the forecast for energy demand. We're going to see energy demand. We're already seeing energy demand for wood go up significantly in Europe. People are going to be burning their stoves. We're going to see, I guarantee you, we will see coal in homes really increase. In China, we see a lot of folks still burning coal in homes. We actually see that. We have it in America still, but you'll see that go up significantly. And I think coal demand overall is going to go up massively. It's not going to flatline. It's not going to decrease because of this, because of the war in Ukraine and because of everything that's happening. I mean, there's energy issues going on right now in China. They have 17% of their grid is hydroelectric, and they are cutting back. They're cutting back electricity massively in cities right now because they have a very hot summer. Lots going on with China separate from that, but very, very serious stuff on the energy security point that is already game changing, and changing the future trajectory and the outlook. And I think a lot of companies, particularly in the US, will have to catch up to that rhetoric and realizing that, the E is not as, from an investment standpoint, may not be the most important thing in the world, that all these other things actually matter too. And there's more to ESG than just the E.
Yeah. So again, I agree with most of everything you said. I guess the one adjustment I would say, is, at least from a ConocoPhillips perspective, obviously we're here to meet the transition demand. We are growing energy. I think we, again, collectively as an industry, need to get smart about how we do it. And if we just ramp up to oil price, we're going to do exactly what we did to ourselves in previous generations. Is we all ramp up and price is going to crash, and then we all lose money, and then we ramp back up, and somehow we need to end the cycle and be smart about it. But I think the change, the other tweak we're making out here and collectively again is we are acknowledging that we could do it more responsibly with how whether it's CO2, probably methane. The more important one would be methane right now with everything we're trying to do around that. There's certainly a more responsible way to do it going forward than the way the industry has done in the past. I think that's the route we're choosing.
Right. No, and I completely agree with that. It's not that I would say, there's a lot of companies that have probably foregone production that shouldn't have at $100 oil price environment and should have ramped up. And then it's really navigating how that comes off, because it's going to come off. And before we close, I would like to touch on, lower oil prices. But you, going back to LNG and your Semprus. So can you talk a little bit about that? I know that's not your day to day in your wheelhouse. But obviously you guys had, talked about Qatar and investment, long-term relationship with Qatar. You talked about LNG out of the Gulf Coast and Semprus. Can you just unpack sort of the big moves that you've made in LNG and what that means for the company? That it is directly tied into your role of producing that gas in Delaware and getting it to market.
I think a lot of what I would say would line up with what's already been said on the earnings call. Is we're big believers in long. Of course, the price will fluctuate, but we're long believers in gas, whether it's domestic gas, international gas. I think we also increased a 10% stake in the APLNG side over in Australia. Again, we're big believers in gas. That's a highly economic asset, and we want to put more gas on the market. So that was part of the rationale there. And the Sempra deal, it seems like a pretty key area for us to get invested into hard assets to take Bakken gas, take Permian gas, take any gas we can, and have access to what we believe is going to be a growing LNG market down the road. So very strategic point on our side to align ourselves with that group to get more LNG on the water.
Right. And I think, that's where I think it's really interesting I think, we have, as you guys have extremely low break evens on natural gas. I mean, I think a lot of companies, I said this in our previous podcast and I mean it, that, history is not going to look favorably upon Shell for selling their asset to you. It's a very smart buy. I mean, you guys did a really good job with Concho, your previous company and Shell, and really have, invested in the right way, even and talking net zero, but you're actually investing in upstream oil and gas and giving yourself a lot of flexibility. And we've seen a lot of majors actually sell out of shale gas in the U.S., which I think is obviously does not look smart at all right now. And truthfully, there was just because it didn't work in their portfolios or whatever, but obviously with prices now, and we have very low break evens in the U.S. So unless you're in the Marcellus, and I love the Marcellus dearly, but you have to build a pipeline in order to grow production and move this to market, and that's really difficult. So let's say Haynesville, basically every other play, if you can get this to market, the break evens are really low. So $9 is over our skis in terms of the economy, and it's something that is going to break people. But $4 is a healthy price for natural gas for returns.
Yes.
For a lot of these that are just pure dry gas. And I think it's interesting to think of, hey, we're willing to invest heavily in LNG. And I'm saying we as in you guys, but the industry, like we're willing to invest in LNG and natural gas, and we're willing to drill into it and produce this stuff because we know that the U.S. has a different price point and that we can put this abroad, and we're exporting 12 billion cubic feet per day. Qatar's exporting about 12 billion cubic feet per day. Australia's exporting about 12 billion cubic feet per day. More natural gas needs to be on the global market. Yes, prices will drop over time, but they're not going to crater because folks need this, and it is a long-term fuel and long-term demand. I think that's a little bit different and interesting in oil, and one that's because oil is a deep and liquid market, and we understand the oil market a lot better, and we move lots of ships of oil around the world, and that's not the same for natural gas. So when just describing the add 12 times through, that's basically roughly your LNG market. And so when we started exporting LNG, we hit the spot market. We change spot prices for global natural gas because it's so insulated, because you have to pipe and compress this, and it's complex. Whereas oil, it's different. And that's what's interesting to me is oil prices are dipping into the 80s. And, I've been honest and comfortable talking about it. I know I'm going to be wrong. I'm okay with that too. But, I think I'm way more comfortable at the end of the year seeing 80s, if not lower now. I didn't think we'd see 80s, quite as quickly as we have. But I think demand is certainly, it's not oil prices that crimp demand. It's oil prices and inflation and high natural gas prices and high everything prices and very, very high core inflation like food and shelter and homes and heating that's really hitting the consumer. UK inflation just came out last night above 10%, and it was core inflation that really had folks worried. So inflation across the globe, energy is a huge part of it. Obviously, fertilizers and the food crisis and everything really compounded. But it's all impacting oil demand. And I think that what I'm not hearing yet in earnings calls, and I have to mention it, is because when I was listening to the Pioneer call, this comment that was made on being confident of $100 oil and strong demand going forward for the next 5 years, I don't see that. And I know a lot of folks disagree with me on that, but I don't see a healthy macro demand environment. I see a supply issues for sure, but I see actually supply coming online in a declining demand market. And I don't think demand's cratering, but it's coming off. So I'm
Yep.
curious as how, you guys think. I know that's not, day to day is a business sort of, but how you think about that personally. How does the company
Yep.
think about that? And, are you comfortable at $80 oil with the levels of inflation that we're seeing? And how do you sort of think about the math, or $75 oil with this inflation? Does it still work? Is it still profitable? Because I'm assuming, to a large extent, it probably
Yeah,
is.
absolutely. I agree with everything you said there. I think so on both sides of the equation, for the Permian, we definitely work at $80 oil. At this price, even with inflation, we're still near $40 break evens. So if you're double that, we're very, very comfortable with where we are. Hopefully, we get some deflation in the market. If we've inflated to $100 equivalent market and it goes down to 80, hopefully we get some deflation in there. But even if not, we are very comfortable with an 80. Just everything we've run internally as well. If we run top side numbers, we run low side numbers, and we're very comfortable with this. And back to your other point on the flexibility of the Permian, if gas does drop as well, we can switch back to oilier zones, or if it keeps up, we can keep heading towards the gassier zones. And of course, I get Pioneer making whatever the statement was around $100 oil, but the only thing we've proven to ourselves year after year, every time we believe any chart you're looking at, but mainly price, if we believe it's going to be up and to the right forever, it's going to change. We're going to have to adapt. So it wouldn't shock me if it's 100. It wouldn't shock me if it's 80. I think anywhere in this kind of band of geopolitics, supply demand, and all the transportation across the U.S., I think that window is very accurate, or very, very appropriate, and we're comfortable anywhere in there.
And if prices were, and this is something I've tried to bring to a lot of clients and folks just thinking about that, to get to think about risk, obviously we could have, algorithmic trading and downside risks. Certainly for, I don't think we have a sustainable supply demand market where, we really tank the market by any means, but, trading can do that. However, I think, if prices would go to 75, 80, inflation should come off a little bit, meaning that if the global economy, if the US economy is softening, unemployment has to rise with interest rates rising. That's a given. It lags a bit, but unemployment's going to rise. And I think that, something that the industry needs to get ahead of is that if you can hire more people, if you have a little bit less, of that tightness on, labor, and you're able to get a little more people in the field, but you have $75 oil, that deflationary, that sort of taking the top off this very fizzy bottle that's about to explode. I mean, I feel like that has to help significantly to sort of ease some of this tightness and some of this constraints. And being, if we're, the economy softening, but this industry is hiring, I feel like, one, that's not just beneficial to people finding jobs, but that's really beneficial to the industry as well. Would you agree with that? And does that helpful even at a $75 price environment? And are you guys thinking about
definitely.
that?
I mean, I think where we are now with just inflation and hiring around the country. I mean, parts of Lee and Eddy County, like Hobbs, that area, they're down to 2% unemployment rates. Midland over here, probably 2 to 3% unemployment rates. So I think any softening, if I heard you right, any softening in other markets would, and if that drives more people back out here, would definitely help get things back on track out here. I don't say that from like things are off the track, but it would help kind of the wobbling of the wheels we talked about earlier. The more people we have out here, in southeast New Mexico, in West Texas, to do these jobs would be fantastic. It would increase reliability of everything. Services being delivered to location would be great. And even at the $75 price range, again, hopefully it comes with some deflation. You're already seeing it in the steel market. Steel's dropping. Hopefully that translates to casing and tubing soon. But hopefully there is some deflation if it goes down that low.
Yeah, no, that's a good point. Is the access then, when that steel prices are dropping, is at least the access to it, even if the prices aren't translating to OCTG, and tubulars and casing, is the access helping, or is that helping on the access a little bit?
Yeah, I've heard of a few other smaller companies out here that they have to wait a couple more days on pipe. Of course, we have larger contracts with bigger companies as well, so we haven't had to wait on pipe yet. But other companies have had to wait for casing, which is rough. Tubing, I haven't heard much of that out there, but yeah, there has been tight. I think a lot of it's been cleared up lately, though.
Well, that's great. Well, I've taken 8 minutes and 54 seconds of your time. We've taken an hour of our listeners' time. You've been a fantastic guest. Is there anything you would like to add that we didn't touch on that you would like to close with?
I guess one of the thought I had earlier, and I forgot to mention it, just going back to your public and public versus private thing, there were comments on, sorry. I don't normally talk this much in my day job. Well, one thing I would go back to on the public versus private, um, I think that's exactly how the market is working. The publics, again, back to shareholder return, back to whatever on their thing is limiting them. I think they're doing exactly what they're supposed to be doing is flat production, maybe moderate, call it disciplined growth or disciplined production. And I think that's exactly what we are collectively are being called to do. But on the opposite side, the private side, they're doing exactly what they're being called to do. They have a high price environment. They're coming off of a low service environment. Granted, it's higher now, but again, their challenge or their task is to go make value for their private investors. Whether it's take a risky area, drill it up on PDP, flip it and sell it. This market is working exactly like it's supposed to be doing right now, which is kind of fun and fascinating to be in part of it. So I kind of like where we are. I don't want the publics to get out there and grow a bunch and then put us right back to where we were, as far as now we're having layoffs and things crashing back down. So yeah, that's one thing I wanted to add in there is I think the market out here is working just like it's kind of designed to do between public and private.
Oh, I appreciate that explanation, and no, it is a fantastic business, and I think it's going to be here for a very long time in terms of needing the commodities and running in the right way and actually doing it efficiently. So Aaron, you've been a fantastic guest. Again, this is the PetroNerds podcast, episode 57. Aaron Hunter, this is the second time we've had him on the podcast, so please listen to episode 38 before or after this because it really helps bring this together. Aaron Hunter is the vice president of the Delaware for ConocoPhillips. Do I have that right, Aaron? Okay. Yes. So fantastic guest, really great podcast. Thank you so much for coming on.
Glad
and
to be here. Appreciate all you do.
All right. Thank you. Bye.